Hi, I'm Gilbert Bong, President, Portfolio Manager, and founding partner of Zelos Investment Council. The month of March was generally negative. The major economic indices that we track, namely the TSX S&P, which represents the Canadian equity markets, the S&P 500, which is a proxy for the US equity markets, the MSCI World, a proxy of global equity markets, and Canadian bond indices finished in negative territory. This was predicated on continued geopolitical uncertainty, which also brought with it higher energy prices, increased the fear of inflation, and changed the trajectory and considerations for central banks. The Zelos model portfolios were designed for these types of environments. Historically speaking, we have seen lower downside capture as compared to upside market participation relative to their benchmarks, and a narrower version in terms of return profiles, resulting in a more stable path for our investors. March was exactly the month to remind us that when assumptions change, markets can reprice quickly. When looking at the history, just given more than 7 years of track record, the Zelos model portfolios have realized less standard deviation and volatility as compared to their benchmark. On average, since inception, realizing 2 to 2.3% less standard deviation than their benchmarks. So why is this important? Essentially, this is important to provide confidence to our clients that we are able to put together a plan which will stand the test of time. I had the opportunity recently to spend a couple days in Toronto with a few of our portfolio managers that we have been with since inception. And sitting across the table, it was great to catch up. I look a little older, they look a little older, but ultimately the process and procedures that have delivered results year over year has stayed the same. Thank you for tuning in, and appreciate the time, support, and energy